RateScope here. Silver just did something it hasn't done since the COVID crash. After a brutal meltdown from the January high around $122 all the way down into the mid-60s, silver suddenly snapped back over 6% in a single day. 1 week it looked like the bull market was dead. Now we're seeing a violent bounce. Everyone's asking the same question. Is the crash over? Or is this just a dead cat bounce before silver heads to $50 or even $40? In this breakdown, I'm going to walk through what actually caused the crash, why we just saw a 6% spike off the lows, what's happening under the surface at COMEX and in China, what big research desks and macro signals are saying, historical examples of similar crashes and bounces, and finally, how I'm thinking about risk, key levels, and what to watch next. This is educational and informational, not financial advice. Always do your own research and know your own risk tolerance. 1. Why silver crashed in the first place. To understand a 6% rally, we need to understand the preceding crash. Two main forces hit at the same time: the Warsh Effect at the Fed, the CME margin squeeze. First, the Kevin Warsh nomination. When Trump floated Kevin Warsh as the next Fed chair, markets heard a very specific story: tougher on inflation, less tolerance for QE and ultra-low rates, a bias toward a stronger US dollar. That's the classic strong dollar trade. Dollar up, hard assets, especially those that just ran hot, get hit. Gold and silver had just gone parabolic into early January, silver near $122, sentiment euphoric, leverage high. When the dollar ripped higher on the Warsh news, a lot of gold and silver holders didn't stop to ask whether fundamentals had changed. They just dumped exposure, especially the leveraged paper kind. Second, the CME margin squeeze. On February 5th, CME Group raised margin requirements on silver futures. Margin is your performance bond. Instead of posting $100 to control $100 of silver, many traders post something like $10 to $15 and borrow the rest. That's leverage. When CME says, "We're increasing margin, you need more cash per contract," that instantly puts pressure on every leveraged trader. They have two options: wire in fresh margin cash immediately, or sell contracts to bring exposure back in line. Thousands couldn't or wouldn't post more cash. So brokers auto-sold silver futures to meet the new rules, triggered margin calls, which caused more selling, which caused more margin calls. That's how you get a crash that looks way worse than any one macro headline justifies. It's mechanical liquidation stacked on top of genuine fear. 2. Why did silver bounce 6%? Now, why the 6% spike? It came from a combination of technical support, short covering, and a shift in macro tone. Technicals. Silver dropped into a key support zone in the low to mid-60s, roughly around $64. This level lined up with prior consolidation and some longer-term moving averages. When we tagged it, a lot of traders who were short from higher prices said, "This is good enough, take profits." That process, short covering, is powerful. Shorts buy back contracts to close positions. That buying pressure pushes price up. Other shorts see price reversing and rush to cover as well. Momentum algos flip direction. You get a vertical green candle not because everyone suddenly loves silver again, but because the most aggressive sellers stop selling and start buying. Macro shift. While that was happening technically, something important happened macroscopically. The US dollar had already run hard on the Warsh nomination. Then the labor data, jobless claims, hiring trends, came in weaker than expected. Weak labor data equals softening economy. A softening economy means the Fed's ability to keep hiking or hold high rates indefinitely becomes more questionable. The market starts thinking, even with Warsh, can they really stay that tight if growth slows? Rate cut expectations started creeping back in around the edges. Gold caught a bid, and as usual, silver, being gold on steroids, moved even more. Historically, if gold moves 1 to 2% in a day, silver can easily move 3 to 6% because the market is thinner, volatility is higher, and leverage is more concentrated. So this 6% jump is exactly what you'd expect in an environment where the mechanical selling is exhausted, macro data undercuts the extreme hawkish forever narrative, shorts take profits at a major support zone. 3. We've seen this movie before. It's worth pausing to remember, this pattern isn't new. Silver has a habit of running too far too fast, getting hit by a combination of margin hikes plus macro scare, then producing a violent bounce that has everyone asking, dead cat or new leg up? A couple of examples. 2011, silver ran from the teens to nearly $49. Sentiment was off the charts. CME hiked margins repeatedly, 5 times in 2 weeks. Forced selling and rule changes triggered a sudden 30 to 40% crash. Price then bounced sharply, before grinding lower for years. March 2020, COVID crash. In the early days of COVID panic, silver was sold aggressively as funds liquidated anything liquid to raise cash. Spot prices plunged into the low teens. But physical coins went to huge premiums and many dealers were out of stock. Silver then ripped higher over the next months, eventually more than doubling. The lesson isn't, this time is exactly like those. It's, sharp crashes followed by sharp bounces are normal for silver. They do not automatically tell you if the bottom is in. You have to look at positioning, macro context, physical versus paper behavior, not just one candle. This current 6% move fits the historical pattern of forced liquidation bottom, short covering spike, big question mark afterward. 4. What the media isn't showing you. China and COMEX. Now here's where mainstream coverage usually stops. They show you the percentage move and maybe mention Fed worries. What they rarely talk about, China's physical buying, and the COMEX plumbing underneath it all. China. Chinese silver products and futures have often been trading at a premium to Western prices. China is structurally in a silver deficit, heavy industrial demand, limited local supply. When COMEX paper price crashes, large Chinese and Asian buyers see discounted physical if they can access it. COMEX. Registered COMEX inventory, deliverable silver, is now around 103 million ounces, down dramatically from 2020. We're heading into March delivery, with February 27th as the first notice day. February has already shown exceptionally high physical delivery on contracts. Almost everyone who can take metal is taking it. That combination, low registered, high delivery, is what drives all the chatter about, will COMEX be able to meet March delivery if too many stand? Under exchange rules, COMEX has tools: offer or force cash settlement, raise margins again to discourage longs from standing for delivery, impose position limits or other rule tweaks. Legally, they can pay you dollars instead of metal in a stress situation. But if they have to do that in size, the trust damage is enormous. It tells everyone that paper silver is not the same thing as a guaranteed bar. Some hedge funds, industrial users, and possibly sovereigns will begin to rethink how they use COMEX. Over time, more demand migrates toward direct physical contracts, state depositories, or non-US platforms. That's how a paper versus physical divergence can grow. We're not predicting that happens on a specific date, but this is why. The 6% bounce can't be analyzed just in isolation. You have to see it against a backdrop of tight inventories, strong physical appetite abroad, and a leveraged, rule-driven paper system. 5. Big bank forecasts and the structural squeeze. Let's talk about the $100 silver headlines you've been seeing. Some major houses like UBS, Citi, and others have put out notes suggesting $100 silver is possible in this cycle. $150 plus could be on the table in a severe squeeze scenario. These aren't guarantees. They're stress test style forecasts. But they're not pulled from thin air either. They're looking at supply deficits, several years where silver demand has exceeded mine supply and recycling, cumulative shortfall in the hundreds of millions of ounces, mine constraints. About 80% of silver comes as a byproduct of other metals. You can't simply tell a copper mine, please dig up twice as much silver, unless copper economics support expanding. Demand growth. Solar panels, roughly 20 plus grams per panel, EVs, multiples more silver than ICE vehicles, electronics, 5G, AI hardware, and grid infrastructure. Their core logic: if demand keeps growing, supply remains slow to respond, and investment demand picks up whenever macro fear spikes, the only equilibrium is higher price. Do I know if that equilibrium is $80, $100, or higher? No. Does anyone? No. But the important point is, the structural squeeze didn't disappear because of a 40 to 50% price drop. The crash mainly blew out leverage, not underlying demand. That's why research desks are still willing to talk about triple-digit silver even after a crash, because the underlying math hasn't improved. 6. Is the crash over or just paused? So, back to the question that brought you here. Is the crash over? From a forced liquidation perspective, a big chunk of the margin-driven selling looks done. The 6% move off a major support zone with volume suggests shorts are taking profit, new buyers are stepping in. The worst panic is at least paused. But crash over doesn't mean price can only go straight up now, or COMEX risk is gone, or macro is suddenly friendly. We still have Chinese Lunar New Year thinning liquidity February 27th and March COMEX delivery risk. Uncertainty around the Fed path, especially if data keeps weakening. The possibility of further margin changes if volatility spikes again. The way I frame the current technical picture, again, not advice, just how I think, is above $80. That zone starts to look like bullish reconfirmation. It would mean the market has reclaimed a big prior support area and rejected the breakdown. Below $64. That reopens the risk of one more flush. Stops get triggered, frustrated longs exit, panic headlines return. That could set a true capitulation low before a longer-term advance. Between those two levels, we're in a high volatility transition where macro variables, COMEX behavior, and physical demand flows are all interacting in real time. 7. What I'm watching next. Here are the 4 main signals I'm watching from here. COMEX registered inventory and delivery data. Does registered silver continue to fall into late February and March? Are delivery percentages staying unusually high? Physical premiums and availability. In China, Dubai, and major Western dealers, are premiums over spot rising or falling? Are lead times improving or worsening? Dollar and Fed expectations. Does the dollar index break higher again or roll over? Do rate cut expectations move earlier or later based on data? Price zones, 64 and 80. Sustained trade above 80 would support the bull resumption case. A decisive break below 64 would warn of another leg down. If this breakdown helped you see why silver snapped 6% higher and what to watch next, not just follow the daily drama, hit that like button and subscribe to RateScope for more real-time macro and metals analysis. I want to hear from you. Are you buying this bounce, or are you waiting for a deeper liquidation, maybe into the 50s, before you touch it? Drop your thoughts in the comments below. This is educational content only, not financial advice. Invest with logic, not hype. RateScope out.